Are chip stocks in a bubble? The cleaner answer is not exactly, but the risk is moving. Right now, semiconductors are being pulled between two very different stories. The first story is valuation. On trailing numbers, the sector looks stretched. Semiconductor stocks recently traded near a trailing price-to-sales ratio of about 19.6 times, which is why bubble warnings keep getting louder. But institutional investors are not only looking backward. They are asking whether future earnings can catch up to today's prices. That depends heavily on the hyperscalers. These companies are projected to spend roughly $500 to $700 billion on capital expenditures this year, much of it tied to AI data centers, cloud infrastructure, and the hardware to run it. If that spending keeps flowing, chip revenue can grow fast enough to make some valuations look less extreme. That is why forward multiples matter. On forward earnings, the sector compresses to around 23.5 times. Still expensive, but very different from the trailing picture. This is not the dot-com bubble, where many companies traded on imagination instead of revenue. Today's leading chip companies are generating real sales, strong margins, and visible demand. The second story is supply. In a classic bubble, supply eventually floods the market. But in advanced AI hardware, the opposite problem is showing up. High bandwidth memory, or HBM, remains a major bottleneck. AI accelerators need huge memory bandwidth to move data quickly, and suppliers like Micron are benefiting from that crunch. Connectivity names are also tied to the same build-out. Major memory supply is expected to remain tight through the end of 2026. That gives the sector a real fundamental cushion. So where is the actual risk? Hyperscaler exhaustion. If the biggest cloud companies spend hundreds of billions of dollars on AI infrastructure, but fail to show clear returns, their budgets may eventually slow. If hyperscalers catch a cold, semiconductors get the flu. That risk may become more important by late 2027 or 2028, when investors demand proof that AI monetization justifies the spending. So the verdict is simple. Chip stocks may not be a pure bubble, but they are priced for execution. The demand is real, the opportunity is real, and the risk is real too. This is market analysis, not financial advice.